Hey all, I just finished reading this famous book called The Little Book of Common Sense Investing by Mr. John C. Bogle. Let me share with you a quick review of the book. But before that, let's learn few quick facts about the great person, Mr. John C. Bogle, also known as Jack Bogle. He was an American investor and philanthropist. He was the founder and chief executive of the Vanguard Group, and he is known for creating the first index fund. He is an avid investor and a money manager himself. He says that investment is very important over speculation, and long-term patience is more important than short-term action. The ideal investment vehicle, in his opinion, was a low-cost index fund held over a period of a lifetime, with dividends reinvested and purchased with the concept of averaging. He was born in 1929 in New Jersey. Right from his childhood, he had a keen aptitude for numbers in mathematics. He graduated from Princeton University, where he studied economics and investment. During college, he spent more time on his famous thesis called The Economic Role of the Investment Company. The thesis itself is a fascinating read, and here is a small excerpt from his college thesis done in 1951. His thesis is named The Economic Role of the Investment Company. He discussed about the importance of mutual funds. The individual investor in most cases doesn't have the time and knowledge to manage his own investment account. He needs the advice of an expert. That's where the mutual fund company comes into picture. The mutual fund company, also referred to as the investment company in his thesis, supplies the investor with this expertise at a relatively low cost, in his opinion. He says that the investment company does a judicious selection of the securities based on extensive research and systematic plan in order to accomplish the objectives of the investment. The second point he mentions in his thesis is that the investors must expect the value of their investment to rise and fall along with the market. But the mutual fund company is likely to dampen the amplitude of the market fluctuations. He says that the mutual fund companies are able to dampen the amplitude because of the fact of diversification. That is, the distribution of investments among different financial instruments. He also discussed the concept of the mutual funds offering the option of reinvesting the gains and dividends from their investments, also called as the growth funds, which help the customers avoid the problem of capital gain taxes. Also, he says that the feature of redemption in mutual funds offers liquidity to his funds at a fair value to the investors, and hence redemption is a very convenient feature. He says that some funds specifically attempt to procure common stocks which will provide a hedge against inflation. He asserts that income from these investments in such companies tend to keep pace with the cost of living, and hence they do a better job than the other fixed income investments. This is what I could make out from his thesis. His thesis, in my opinion, shows a beautiful picture of the mutual fund industry. An ideal world where the mutual fund industry stands by the fiduciary duty of protecting the interests of the investors. Personally, I don't have any key takeaways from his college thesis, except for certain statistics and the mechanics of the mutual fund industry. Maybe Mr. Jack Sir was digging deep and learning more about the mutual fund industry in general during his college days. After graduating from Princeton University, he was hired by Wellington Fund, where he concentrated on analyzing the company and the investment department. Over a period of time, he grew up to be the chairman of Wellington. Later, he was fired because of an extremely unwise merger, in his opinion. Later, in 1974, Bogle founded the Vanguard Company, which is today one of the most successful companies in the world. In 1976, he created the first index mutual fund and gave it to the general public. It was not well received in the beginning, but later it gained popularity. Bogle suffered heart issues. He had a heart transplant and later retired from Vanguard in 1999. After 10 years of working at Vanguard Research Center, he died in 2019. He will always be remembered for introducing the concept of index fund and coming up with the consumer version of investing. By making people aware of the expenses and making it clear to them that over long term, most of the investment managers cannot outperform the broad market averages. Long live Jack Bogle for being the leading proponent of the beautiful concept of indexing. Let's get back to the review of the book. The book starts with a parable, a small and beautiful hypothetical situation of a family called the Gottschalk family. This story was shared by Mr. Warren Buffett himself in his annual report with his shareholders. There once lived a wealthy and happy family named Gottschalks with many generations of brothers, sisters, aunts, uncles, and cousins. They owned 100% of each of the stock of the United States of America. Their wealth compounded over decades. All the dividends from the companies, all the earnings were in their hands. They were clearly playing a winner's game. After a while, few fast-talking helpers arrive on the scene and convince the cousins to exchange their shares of some companies with other family members. The helpers promise to handle all these transactions by taking some commission. The family wealth begins to diminish. To make the matters worse, they hire professionals to help them pick good stocks and then managers to hire these professional stock pickers. With all these added costs, the family's wealth tumbled. The family members were alarmed by the dwindling wealth of the family. Then finally, the wisest family member, a sage old uncle, comes to their rescue and offers a great suggestion. How the family gets back to square one and regain all of their wealth and live happily ever after is discussed in this chapter. Make sure you don't miss out on this enchanting story that we can all apply to in our financial lives. The story ends with a word from Mr. Warren Buffett himself. For investors as a whole, returns decrease as motion increases. The higher the level of investment activity, the greater the costs of the intermediaries and taxes. Hence, lesser are the net returns of the investors. That's where indexing comes into picture, and that's the central message of this book. He then divides the stock market return into two parts, the investment return and the speculative return. The investment return is nothing but the dividend yield given by the companies and the earnings growth potential of the company. Hence, investment return is the core and intrinsic value of the company. Speculative return, on the other hand, is associated with the emotional aspect of the investor. Speculative return is often reflected in those changing PE ratios. He says that forecasting the investment return and understanding the long-term economics of investing gives us a greater chance of success rather than forecasting the speculative return. The changes in speculative return come back to normal and hence we do not need to worry much. Also, it's dangerous to apply those past speculative returns to the future returns of the investment company. Make sure you check out the graphs of investment return versus market return in chapter 2. In chapter 3, he discusses that we should cast our lot with the US stock market, which means we should invest in all the stocks of the United States and hold them forever, at least a portion of all of them. He discussed that S&P 500 index holds the top 500 US stocks, and there is one more index called the total stock market, which consists of these 500 stocks and additionally 3000 more stocks. He also showed a comparison between S&P index and the other active funds for 15 years from 2001 to 2016. He compared the performance of S&P index with the other actively managed funds. All in all, there were not many funds actually which outperformed the S&P index for those 15 years. Be sure to check out these exhibits in this chapter. In conclusion, he says that active funds come and go, but the index funds remain forever. In chapter 4, he beautifully explains how the investors as a group fail to earn the returns that the great American corporations generate. He says that investors turn a winner's game into a loser's game. This is because of the management fee, the portfolio turnover fee, brokerage commissions, sales loads, advertising costs, all of those operating costs, the legal fee that the mutual fund companies put on the heads of the investors. This is the simple, undeniable reality of investing. The actively managed mutual funds charge 2% to 3% per year, in contrast to the 0.5% charges of index funds. Yes, costs therefore matter because these costs get compounded year after year. This is what he calls the tyranny of costs compounding. He shows wonderful comparisons of the assumed market returns of 7% before costs and 5% after costs, and how these differences in the costs multiply year after year, and how this gap widens, and why these costs matter to us as investors. In chapter 5, he suggests that we should focus on the lowest cost funds. If there is anything in the whole world of mutual funds that you can take to the bank, it is the expense ratios that help us make better decisions. Lowest cost funds beat the higher cost funds at any day. He explains why we have to focus on funds in the cheapest or two cheapest quintiles, and then we will be on our path to success. In chapter 6, he discusses about dividends. He says that a staggering portion of the equity fund dividend income is consumed by the expenses of the actively managed funds. He shows the figures of the net yield given to the investors of actively managed funds versus the low-cost index funds. In chapter 7, he says that the returns reported by the actively managed mutual funds are rarely earned by the mutual fund investors. After paying the heavy costs that the fund managers extract for their services, the shareholders pay an additional cost, which is what is explained in chapter 7. There is a difference of about 1.5% annually between the actively managed funds and the indexed funds, and this difference compounded over a long term turns out to be huge. He also says that investors put in a lot of money with the over optimism and greed when the markets are in a peak high position, expecting that the same kind of beautiful results in the past will be repeated. But there is something called as reversion to mean, which he will explain in the later chapters, because of which the mutual funds will decline in performance, and moreover, some mutual funds will just go out of the list, they no longer exist. The investors keep falling prey to their emotions and trying to buy new funds which promise to meet the fads and fashions of the day and are often supercharged and speculative. He explains how and why the beauty of the index fund lies not only in its low expenses but in its elimination of all those tempting fund choices and promises that they make to the investors. In Chapter 8, he explains that the actively managed mutual funds are astonishingly very much tax inefficient and hence the investor receives far less return. These taxes also, like the other costs accumulated over a period of time, show an active fund lag. And the last very important point of his book that we should all know about is reversion to the mean, which means that yesterday's winners might be tomorrow's losers. How successful are fund choices based on the number of stars awarded for such short-term achievements? Not very. According to a 2014 study by the Wall Street Journal, only 14% of 5-star funds in 2004 still held that rating a decade later. He shows us many exhibits explaining why we just can't select funds which would outperform their peers by simply buying yesterday's winners. This is because of the reversion to the mean. Picking winning funds based on past performance is a dangerous duty. Yesterday's winners will most likely not be tomorrow's winners too. On the basis of the theory of reversion to mean, the funds promising exceptional returns have to return back to the normalcy again. I hope you enjoy this informative and insightful book and understand that the road to investment failure is paved with expensive advice, expensive instruments, and expensive advertising. As Mr. Bogle suggests, a different course is there for investors, virtually guaranteeing investment success with the path of index funds. Choose the path of index funds, stay the course and hold on forever. And I wish you good luck.